Hi there, and thank you so much for tuning into this video today. I know so many of you have been anxiously waiting for us to make this presentation, and unfortunately sickness kind of came through our household and I wasn't able to, I lost my voice and then I had a stomach flu. I guess that's the benefits of having three young ones going to school for the first time, is they bring all the wonderful germs and disease back to the home for us. So it sure wiped out our household. But anyways, we're excited to show this. We think this is one of the most amazing strategies that we implement for our clients. The benefits are without doubt some of the most impactful for all of our clients as they face their retirement and enter into their retirement income years. So for those of you who don't know me, I'm 𝐏𝐫𝐸. I'm an advisor with Precedence Private Wealth, and I'm also the Senior Investment Advisor with Precedence Capital and Gravitas Securities. So today what we're going to talk about is a strategy that we implement for our clients at Precedence Private Wealth that moves registered assets from RRSPs, LIRAs, and pensions into tax-free savings accounts in a tax-neutral manner. So why would anybody want to do this? Well, first of all, the government owns half of your RRSP and pension, which means if you were to withdraw all the assets at once, you would pay north of 50% tax on that. Now, obviously there's tax management strategies where we try and reduce that income as much as we can in retirement, but the tax burden nonetheless is still there. So for a client that has $1 million inside their pensions and RRSP, they actually are going to have to pay upwards of 40% just to get the income out of that RRSP. So their after-tax retirement is not $1 million, it's actually an after-tax factor. So if you take a tax bracket of, say, an average of 35%, well then obviously $650,000 is the net income that can come out of that $1 million RRSP. Super substantial. And up until recently, there haven't really been many strategies around this to actually address this fact. And with a little bit of creativity and using what CRA has to offer, we're able to implement this strategy which has maximum benefit and amazing risk reward. So let's get into exactly how this works. So for this example, we're going to take a client who is age 56. They have $500,000 in an RRSP. They have $100,000 in a tax-free savings account. They're going to continue to make $11,000 of annual tax-free savings account contributions. So they're going to maximize those contributions every year. We're going to assume a 6% projected annual growth on the non-registered investment. We're going to use a 35% marginal tax rate. Obviously, this will vary depending on the amount of income you're earning in retirement. And we're going to run this strategy all the way to age 90. What the TFSA maximizer strategy, or what this strategy entails, is it utilizes three different things. One is just the simple withdrawal of money out of a RIF. So that's not any different than once you hit retirement, you convert your RRSP or your LIRA or your pension into a RIF or a LIF where you're actually drawing income. The second is we actually set up a personal mortgage, so a non-arm's length mortgage on your own property that you actually own. And that we'll cover exactly what rules CRA, what the exact rule is that CRA allows us to do that later on in the video. And then the third thing is we borrow to invest, and we'll also discuss the exact criteria that CRA requires in order for us to perform that. So by combining these three like siloed, very well known and very well documented wealth management strategies, we're able to create a system that will be able to transfer assets from otherwise taxable registered accounts to non-taxable and tax-deferred growth inside a tax-free savings account. So for those that are really unsure of exactly what the difference is between an RRSP and a TFSA, I'll explain. So an RRSP, when you make your initial contributions, you receive an upfront tax deduction. Eligible requirement is based on the amount of room that you have. So if you make a $10,000 contribution to your RRSP, you actually get a $10,000 tax deduction against your income, which can result in a tax refund if you prepaid that tax, obviously off your payroll or out of your business, etc. So for the most part, let's say at a 35% tax bracket, you would get $3,500 back in income tax for that $10,000 contribution, which is very, very beneficial. That's one of the major reasons why clients continue to use RRSPs to fund their retirement. Now, money that grows inside an RRSP actually grows tax deferred, which means you don't have to pay any tax on any of the compounding growth as your investments perform. They deliver interest, capital gains, dividends, etc. What you will not have to do is claim that as income tax or claim that as income and have tax on that income every single year. Now, on the contrary, a tax-free savings account is an investment account where you make a deposit into the account, again based on qualification of TFSA room, and instead of getting the tax deduction up front, you actually just get the benefit of tax deferred growth of your investments over a prescribed amount of time. So the major difference between the RRSP and the TFSA lies in the tax deduction going into the RRSP, but most importantly, when you withdraw money out of an RRSP, you have to claim it as income. And that's what we're tackling today, because that is substantial. It's a substantial impact for our clients in their retirement, and it's something that is very, very taken for granted. On the flip side, the huge advantage of a tax-free savings account is that all growth is tax deferred, just like in the RRSP. However, all withdrawals in the future are also tax-free. So you can see where the benefits arise there. So how can we utilize getting money into an RRSP, receiving the upfront tax deductions, but also have the ability to pull money out of a tax-free savings account without any tax liability? That's exactly what this strategy entails. So let's dive right into it. So for this example, we're going to take the $500,000 RRSP. So we're going to have two accounts. This is going to be the $500,000 RRSP. This is going to be the $100,000 tax-free savings account. And this is the value. So you can see the difference in values. Now, you can use any numbers, like we're just using this as an example, the 500,000 plus the 100K. You could have twice as much in RRSPs, you could have half as much. The higher the concentration of tax-free savings account relative to the RRSP, it's going to be more beneficial and faster. We'll explain that in a little bit. But for the most part, really what you're doing is you need to have a tax-free savings account with a substantial amount of assets in it in order to really take advantage of this. So what we do is that $500,000 and that $100,000 tax-free savings account, rather, what we do is we actually sell it to cash. So you sell every single investment inside your RRSP and your tax-free savings account, and you sell it to cash. Then what you do is we help facilitate a personal non-arm's length mortgage on your own residential or commercial property where you actually are investing in that mortgage. So what does that mean? So in Canada, you can actually own your own mortgage inside your RRSP. You've been able to do this for several decades. We'll go through the CRA bulletin later on in the video that states exactly what this fact is. But the reason why you're able to do that is, let's say that you had an RRSP that was earning, 2%, and you're in GICs, etc. And your mortgage is actually at 3.5%. Well, what you could do is you could actually lend yourself the money from your RRSP, and you could actually make mortgage payments to yourself instead of making them to the bank. Now, most people don't invest in guaranteed securities or bonds or anything because of the low interest rates. So they're in balanced funds, pensions, etc., to try and get a higher rate of return. So that's very uncommon nowadays. However, using it still within this strategy is very, very beneficial. So now that you've set up that mortgage, and we'll get back to the qualification and how that works, but when you set up that mortgage, you're actually applying for a mortgage. You still have to go through the same underwriting, the same types of criteria. But what happens is, instead of going to the bank and actually getting them to lend you the money, you're lending yourself the money. But when you lend yourself the money, it actually has to land somewhere. So what we do is we send the funds to a non-registered investment account, which otherwise known as a taxable account. Now, why would we want to do that? Recall from the initial point that I made about having tax deductible interest or having an investment loan. The reason why we want it in a taxable account is because we need the interest to be tax deductible. So any interest that is paid is tax deductible. And that'll become crucially important later on. So now we have this mortgage. So now we've invested the $500,000 and the $100,000 TFSA into an actual mortgage on our own property that we have taken the proceeds, and you can. And the cool thing about in this non-registered account is you can replace the assets that you bought before, so that you don't actually have any lost opportunity cost. So whatever investments you owned in your RRSP and your TFSA, you can do this exact same thing over here. Some people could choose to maybe take less risk because of the advantages of the strategy. There's so many different ways that we can do it, but for the most part, let's keep it simple. It's going to be in a non-registered taxable account. So the RRSP and the TFSA. Now the crucial part here, and this is the magic of this system, is that they're invested inside a mortgage, but they're given two different types of qualification. The RRSP is a first mortgage, and the tax-free savings account is a second mortgage. Now what that means is a first mortgage means that upon a default of the mortgage, so let's say that the bank lends you money, you are making your mortgage payments, and for whatever reason you stop making your mortgage payments, you're unable to fulfill that debt obligation, the bank becomes first payer. If there was a second position, the first payer will always get paid first in the event of default. Therefore, they have much less risk than the second payer in any circumstance. And that's pretty common sense, so that makes sense. The advantage of that is the first mortgage, if you're on first title and you're in a first mortgage position, you're going to get competitive rates at a bank or credit union or through the brokerage channel, through a mortgage broker, and it's going to be anywhere, and let's just use a round number, but let's say that it's 3%. And that's going to be super advantageous. The second or third mortgage, which will be on this scenario, will actually be able to charge a higher amount because of the risk position. It's not going to be as secure as the first title. Therefore, you can charge anywhere from say 6 to 15%. And realistically, that makes sense, because if you had far more risk being second payer, like so consider mortgage investment corps or advanced mortgage structures for land development, different things, those types of mortgages, they pay a higher rate of interest because they have to. It's no different than a Canadian government bond paying a rate of interest versus a corporate bond where there's a higher chance of default. The interest rate has to be higher. No different on the lending side. So why would this be an advantage? Well, here's how this strategy and how the cash flows work. So what we do is every single year, we take out via a RIF or LIF if it's a pension, or LRIF if it's a locked-in retirement account. But for the most part, it's going to be a RIF. What we're going to do is we're going to pull out the annual amount of income. Now this normally is a taxable event. If you withdraw $10,000 out of your RIF, you have to claim that as $10,000 of income, so it's taxable. What we do is, now you've pulled out that taxable amount, but you have to actually make the mortgage payments on this mortgage that you set up. So just because you lent the money to yourself, you still have to make those mortgage payments. So you make those mortgage payments back to the RRSP and to the tax-free savings account. But you do it in this interval: 3% interest in the RRSP, 15% interest or a prescribed amount that we declare is into the tax-free savings account. Now, as you can see, if you were to continue to do this and ignore taxation in the beginning, you can see that over time, this will erode to zero and 100% of the assets will be in this bucket, which would leave 100% of the mortgage being invested in the tax-free savings account. But the magic is, because the proceeds of the actual mortgage were used to buy non-registered investments, which ultimately could be the same risk or less risk. So there's no additional risk, there's no additional market risk or anything like that, just a transfer of how the account is taxed. This actually is a tax-deductible expense. So the tax-deductible expense, which ultimately is the interest on these mortgages, cancels out the taxation on that RRSP payment. So now if you fast forward, all of the money month after month, year after year gets contributed to the tax-free savings account, and a zero is left in the RRSP, your assets are still able to continue to grow inside a taxable account, which when you withdraw on them is much more tax favorable. Dividend rates, capital gains rates, etc. at 50, sometimes 30%. Whereas the RRSP would normally be 100%. So the advantage is there's no opportunity cost. It's not like you're locking up your assets and you're not continuing to grow your assets inside your RRSP or tax-free savings account. It's actually the opposite. It's very otherwise, is that your assets continue to grow in the non-registered account and we're able to change the taxation on the initial $600,000 that is invested here. So again, let's go through this one more time. You set up a mortgage structure that has two components. One is a first mortgage with your RRSP assets in it. The second is a mortgage on second title, which has your tax-free savings account assets. The reason why we want to have the separate structures is we want to take advantage of the additional risk of a second title mortgage inside your tax-free savings account versus your RRSP. That way, the interest on the RRSP that we have to pay back to the mortgage is only going to be 3% relative to the 15% in the higher risk portion of the tax-free savings account mortgage. Every single year, we pull out the taxable RRSP payment, or normally taxable RRSP payment, that exactly matches the cost of interest for that mortgage. And then once again, because the proceeds were used to fulfill and buy a non-registered investment, that interest is tax deductible. That ultimately cancels out the tax on the RRSP, and you're left with a tax neutral transfer from your RRSP to your tax-free savings account. So now, many of you might say, okay, well, I'm not really sure on how this mortgage would work. In Canada, when you get a mortgage, there are two components. You have the borrower, and then you have the lender. In Canada, you're allowed to actually be both as long as it's registered in an insured mortgage. So what that means is, if you register the mortgage as a lender and you set up a mortgage structure that is CMHC insured, it qualifies even though it's at non-arm's length, which means you're actually owning or lending money to yourself. You can do that inside your RRSP, you can do that inside your tax-free savings account, you can do that inside your pension. You can do that inside any registered account as long as it is a CMHC insured mortgage. The borrower is yourself. So the borrower is not any different than if you're borrowing from the bank. You still have to qualify for the debt. So even though you're lending it to yourself, they're two separate entities, and this mortgage structure actually doesn't know that you're the borrower. In theory, there's like a Chinese wall in between. And what happens is you still have to qualify, you'll still have to income test, so that doesn't change. But what happens is it allows you to provide this structure so that you can take advantage of this strategy. So now let's review the benefits of this overall strategy. Number one, you're able to obtain a tax-free retirement income from your tax-free savings account instead of from your registered accounts such as your RRSP, LIRA, and pension. Number two, the advisor management fees that you normally pay on your RRSP and your tax-free savings account now become tax deductible because you're paying them on the investments inside a non-registered taxable account. If your advisor is charging you between 1 and 1.5% in management fees, if that's tax deductible, you're going to save up to 50% of that, given based on your tax bracket, but you're going to save that in tax, which means it reduces your fees overall and further enhances your tax position. really without doing anything. So the difference is the money managed in this account is going to be the advisor fees are tax deductible, whereas all money managed inside of an RRSP or tax-free savings account, the management fees are not tax deductible. So it's a huge difference. Number 3, it obviously gives you an opportunity to maximize retirement benefits. It's unbelievable to consider that if you could have $1 million in your RRSP, transfer it over to your tax-free savings account using this strategy, and over time, it could have zero impact on receiving income benefits such as old age security and CPP. Now, what's amazing is most people that have $1 million RRSP, they're not going to qualify based on the income test because of the taxable nature of their withdrawals. So they're not going to qualify for old age security. So that is something that's, it's not a lot, but it's every dollar counts, and it's going to maximize your retirement income even further. And number 4, it gives you an opportunity to transfer all of your assets within your estate in a non-registered or tax-free manner versus having them taxable. Because as soon as death occurs, the estate takes consideration as if all of the assets were sold at the date of death, which means that it's all taxed in the hands of the deceased all at the same time. So if you took $500,000 all at one point, all $500,000 will go into income, which means you'd be at the highest tax bracket. So virtually almost 50% of that money is gone. Whereas if it's in a tax-free savings account, 100% of it transfers to your beneficiaries or bequeathed through the will. So now let's talk about and give consideration to the risks. The biggest risk really is not in whether this strategy works. Like, it's based on economic fact. It's based on 3 very well documented and very well supported wealth management strategies. The key is in the unknowns and the nature of actually doing this type of strategy. So number 1, you're going to have the same or similar general risks in your non-registered account normally as you would inside your RRSP. You're not going to have more risk. You can take more risk if you want, but more often than not, you will have similar risk or even slightly lower risk because of the advantages of the strategy than you would inside your RRSP. So you're not going to have additional market risk that's not considered. Number 2, you actually default on your own mortgage. This is like the definition of insanity. Nobody in their right mind, if they're lending money to themselves in this mortgage structure, is not going to make those payments. That would mean that when you take this RRIF withdrawal, you actually don't make your payments. That would be just straight stupid. But nonetheless, you have an obligation to the lender. Even though you've lent money to yourself, it's still 2 separate entities, the lender and the borrower, and you have an obligation. So that would be an apparent risk. And number 3, any time that you do any type of advanced tax strategy, CRA is going to look at these. If you start to have $500,000 or $600,000 listed and shown inside your tax-free savings account, mark my word, they are going to look at it. And that's fine. As long as we make sure that we qualify all the steps along the way, there's no audit risk other than just the time and energy, but that's far, the extra time and a little bit of cost to do the extra accounting is far outweighed by the benefits of having a tax-free retirement. And so now let's talk about these rules. So number 1, obviously borrowing to invest rules is very, very crucial because it gives you the tax deductible nature of the investments themselves so that we can actually write off the, or have a tax deduction against the RRIF income that flows out of the actual mortgage strategy. So CRA Taxfolio S3 F6C1 is interest deductibility on money borrowed to invest. And it clearly states, interest paid on money borrowed to invest is tax deductible. Assets must be held in a non-registered taxable account. They must be available for any asset class that meets the income and profit test. That would include stocks, bonds, mutual funds, businesses, etc. It has to have the potential to pay income. So what would not qualify is like art or land that is not leased or gold, physical gold that doesn't pay out any income. So for instance, you can't own an actual gold bullion ETF because it doesn't technically pay income. You would actually have to own gold companies that would have the potential to pay dividends and income and capital gains. So as long as those criteria are met, we satisfy that juncture of the CRA requirements. Number 2, eligible investments inside an RRSP and a tax-free savings account. CRA IT 32OR3. Personal mortgages are permitted if they are, number 1, insured by CMHC and administered by an approved lender. And number 2, they're invested into what is called a mortgage investment corporation. What a mortgage investment corporation is a structure that actually carries the mortgage itself and has an obligation to the shareholder to pay that dividend or distribution for that money lent. Mortgage investment corps are very, very common in Canada. A lot of them deal with like hundreds, if not thousands, of pooled investors that contribute to a mortgage investment corp and then earn interest. It's just what happens is, in this case, you would actually be not only the shareholder, but you would actually be the lender as well through that MIC. So let's talk about who's involved in this platform. So obviously we spearhead and we manage this entire process for our clients, and we utilize the following companies. Obviously the mortgage has to be CMHC insured, and that's a given. So what we do is we've outsourced and we've partnered with an approved lender, MLink, and they're based out of Toronto. They do mortgages across Canada, and what they do is they're an approved lender with CMHC to facilitate mortgage lending. We carry your RRSP and your tax-free savings account. You would actually set up trust accounts with Computershare, which is one of the largest trust companies in Canada, and that is where your actual RRSP and tax-free savings account mortgage will actually sit. And then number 3, we manage the investments for you here at Precedence Capital and Gravitas Securities to make sure that it satisfies all income tests so that that interest remains tax deductible. So the elephant in the room here is that obviously in order to invest in this strategy and use a personal mortgage, you have to actually have a free and clear property in Canada. Now, that doesn't necessarily mean that you have to have full title free. You can still set these up as second and third mortgages, respectively, but it really is optimized for someone that has a free and clear property in Canada that can leverage this strategy. Now, if you might not even be at this situation, or you're a few years away, if you're concerned and you think, holy smokes, I'm just starting, I just bought a new house, I'm still building up my RRSP assets and my tax-free savings assets. If you want, check out an earlier video that we had posted previously that discusses the tax-deductible mortgage strategy. In this strategy, what it does is it actually allows Canadians to pay their mortgage off in upwards of half the time by simply making their regular mortgage payment. And the benefit, obviously, the quicker you can get to a mortgage-free position, the quicker you can start to implement this strategy, which is going to provide amazing benefits to your retirement and your overall wealth. So there you have it, folks. That is the outline of how we actually convert our clients' RRSPs, pensions, and locked-in retirement accounts into tax-free savings accounts and move the assets in a tax-neutral position to garnish a much more favorable retirement and tax-free income for our clients. Please leave your feedback. Obviously we went through this somewhat quickly, but we're super excited to show this to as many Canadians as possible. Provide your feedback below. Ask lots of questions. We're going to be answering to every single person that inquires. Ask specific questions. If you want more confidential discussions, please reach out to us. You can reach out to us at www.precedencewealth.com, or you can even hit us up under direct message on Facebook, Instagram, etc., and we can start a conversation at that point. But the best thing to do, obviously, is to see your own numbers at work, see how it's going to impact your retirement, and see what benefits we can create for you so that you can have the most enjoyable retirement possible.